Hey everybody, Smart Silver Stacker here. Today's live stream is brought to you by SD Bullion. Buy your gold and silver at sdbullion.com. Right now, new customers can get gold or silver at spot by visiting sdbullion.com/new. Now, let's talk about silver and the price of silver, because the price of both precious metals, gold and silver, appears to be, from my point of view, on the verge of a major breakout. And there are economic factors that are contributing to this. There are geopolitical factors that are contributing to this. We're going to talk about both of those in this video. But first, I just want to take a look at the chart. And we've looked at this several times in the past, but it's important to look at the updated chart because we are approaching, in the price of silver, this upward line here, this line of resistance. It's drawn from the 2011 highs of around 50 bucks all the way down to where we're at today. And this is forming the handle of a cup and handle formation, a very bullish technical pattern on the silver chart. You can see the cup here and the handle here. And we are very close to breaking out of this handle. You see, we broke above it briefly. This was around the same time that gold surged to new all-time highs in that overnight trading, but we weren't able to stay above it. But I think when we get a close above this line, once again, which we're getting very close to, both gold and silver in the green once again today, it's probably going to be off to the races for the precious metals. Now, of course, nothing is guaranteed, but I think that the odds are in favor of a breakout very soon, and that is informed by this chart and also, as I mentioned, the developments that we're seeing around the world. And it's a similar story in the chart of gold. You can see this long-term cup and handle formation, a little prettier maybe than the formation on the silver chart. And also, we are getting very close to this upward line. Of course, we blew through that Sunday night a couple weeks ago up to about 2150, a new all-time high for gold, but that was smacked down quickly. That was only an intraday trading. We need a close above this upward line, and then again off to the races for gold. And I think where gold goes, silver will follow, perhaps even a bit more so. So let's talk about the factors that are likely to get us above this line and kick off this bull market that we are going to see in the precious metals in 2024. At least that's what I am forecasting. Now, first of all, take a look at the chart of the dollar here, the DXY. Now, a lot of times when I talk about the price of gold and silver moving up, as they are today, I get a lot of feedback where people say, well, gold just moved up because the dollar went down. And while that is kind of true, gold and silver are both sort of inverse to the US dollar, the paper fiat US dollar compared to real money, that being gold and silver. It's not like you can just say, well, gold went up because the dollar went down. I mean, something drove the dollar down. So what is driving the dollar down today? Well, it's an inflation reading. The PCE, as they say, the Fed's preferred inflation gauge, just came out a little cooler than expected. And it's interesting to think about how a cooler than expected inflation number could drive the dollar down relative to other currencies. But that's the kind of clown world economics we live in this economy that is run by the Federal Reserve, because of course the only thing driving price action in these markets any longer is the anticipation of what the Federal Reserve is going to do next. And I see some folks in the chat saying, hello, Merry Christmas. Yes, Merry Christmas to everybody. Do me a favor, smash that like button if you're tuning in, help get this information out into the algorithm. And with that being said, let's talk about this PCE inflation numbers. So the core personal consumption expenditures index that excludes food and energy prices, it was ranked at 3.2%. That's the year-over-year reading for the month of November. That is lower than the estimate of 3.3. Now, notice that's still well above the Fed's target of 2%. But if you look at this gauge on a 6-month annualized basis, it comes in at 1.9. So actually below the Fed's target of 2%. Now, I mean, anybody who's actually a consumer who has to go out and, pay for food, pay for groceries, pay for rent, I think we're all aware that the official inflation numbers are understating what is really occurring. But that doesn't mean that this data isn't worth paying attention to, because the Fed, I mean, they certainly act as if this data is official. And what may be going on here is that, if they're manipulating the numbers lower or, whatever, I'm not going to speculate too much about that. But this gives them the cover that they need to cut rates in 2024, which is what markets are anticipating at this point. And this is part of why the dollar is dropping and gold and silver are up, because markets are becoming more convinced that if inflation is normalizing, inflation is coming down. I mean, of course, look, I understand. Inflation would have to go negative. We'd have to have deflation to get back to anything resembling, quote unquote, normal prices. But this is the data that the Fed looks at, so it's important. And Luke Tilley, the chief economist for Wellington Trust, said in response to this, it is clear that price pressures are abating and the Fed should cut rates accordingly. And you can expect to hear more of that talk as these inflation numbers continue to come down. Now, I don't believe that it's because the Fed has done anything to meaningfully address the issues. I mean, the Fed balance sheet is still massive. If anything, the Fed's program of rate hikes has served to eviscerate our debt-based economy and perhaps destroy demand to some extent, because consumers, the biggest driver of the U.S. economy, are now becoming impoverished and in debt up to their eyeballs, and they're defaulting on that debt. But nonetheless, this means that the Fed will have an excuse to print. And so I thought there was something else from this article I'd highlighted. I guess not. All right, so you can see this reflected in the CME FedWatch tool here. This is the target rate probabilities for the 20th of March. That's the FOMC meeting in March of 2024. And you can see that the market now pricing in a greater than 86% chance of rate cuts. You got 74.2% chance of a 25 basis point rate cut, and then a 12.2% chance of a 50 basis point cut. So this number's going up. The trend is higher following these inflation numbers. Now, let's get on to the geopolitical, because I'm pretty convinced that the Fed is going to print. I mean, if anything, I think markets are underestimating the amount that the Fed is going to print. I think that in addition to cutting rates, they're going to be going back to QE, because we still have, a massive liquidity crisis and all this. But let's talk about the geopolitical events, because this may be even more important for the price of gold and commodities moving forward. So we've been talking quite a bit about what's going on in the Red Sea, something that is likely to contribute to much higher inflation in 2024. I mean, the Fed's going to print anyway, I think, because they have to stop the whole thing from falling apart. But the inflationary effects, they're going to be significant from the amount of money they're going to print. They're going to be exacerbated by this supply chain disruption, which is taking place in the Red Sea right now. You have Houthi militants or terrorists or rebels, whatever you want to call them. I mean, that's what the mainstream labels them. They're basically the de facto government in Yemen. But they call them militants because that way, it kind of affects how they're able to respond to them if they don't consider them a sovereign state. Gives the U.S. and allies a little bit more free range with how they deal with these Houthis. But now, today, this latest development, we're hearing a statement from Western and regional security officials, according to the Wall Street Journal here, that Iran's paramilitary forces are providing real-time intelligence to Yemen's Houthis, and that the rebels are using this data to direct drones and missiles to target ships passing through the Red Sea. So already, a large number of shipping companies are avoiding the Red Sea, adding on many days and many thousands, tens of thousands, hundreds of thousands of dollars to the cost of these voyages. Now, that is going to have a significant effect on supply chains. I think IKEA was already saying that they're possibly going to have empty shelves in the months to come as a result of this. And that's just, the canary in the coal mine. You can expect that probably beginning sometime in January, February, you're going to start to see things become less available. Prices are going to increase as the cost of all of this shipping. I mean, the shipping companies aren't going to pay for this stuff. You understand that, right? You are. Consumers are going to be the ones who pay for the higher cost of shipping. Shipping companies, they just raise their rates when the cost of shipping goes up. So ultimately, we're all going to pay for this in the form of higher inflation. But, this is the cost of all of this Mideast military adventurism, and now we're all going to pay for it. But now it looks like Iran may be getting drawn in. More likelihood of U.S. intervention, U.S. and Western intervention against Iran. Now, the Houthis are denying this. They said, it's strange to attribute everything to Iran as if it were the world's strongest power. We have intelligence facilities that have proven themselves over the years of aggression against us. However, the West says that the Houthis don't have the radar technology needed to target the ships. They need Iranian assistance. Without it, the missiles would just drop in the water. Now, it's probably accurate to say that the Iranians are assisting the Houthis here. I mean, I don't think that that's too much of a stretch, but the idea that we need to intervene here and bomb Iran or have some kind of a forceful response, there are a lot of hawks now calling for that, not the least of which was Lindsey Graham. He was telling us we should bomb Iranian oil infrastructure to teach them a lesson. But the current administration is attempting, it seems like, to avoid escalation here. So the thing about this military adventurism that we have in the Middle East, it's like you kind of got to commit to it one way or the other. I think if you're going to put a bunch of U.S. forces over there, let them be sitting ducks, let them be targets, support the war that's currently going on in Gaza, then you kind of have to back that up, because otherwise you get what we're having now, where these militants, they feel emboldened to continue these attacks. We're trying not to escalate things because Biden doesn't want the price of oil to go to $150 during his election campaign in 2024. That would kind of throw a wrench in the gears for these politicians who are going to be running. But nonetheless, it's looking more and more like that might be the case, because when push comes to shove, I think the U.S. has shown that it is more than willing to use military options in the Middle East, as disastrous as that may have been over the past couple of years, past couple of decades. It doesn't seem like we've really learned the lesson from that. So if this should kick off, if the Iranians are, supplying intelligence, assisting the Houthis here, or at least the West is, perpetrating that narrative, whether it's true or not, I don't know. I mean, it seems potentially, like it could be the case, but nonetheless, the response I don't think is going to be good for anybody except for perhaps the folks who are selling the weapons. With all the uncertainty here, though, one thing is for sure: we're going to spend a lot of money on all of this. This Operation Prosperity Guardian, one of the biggest naval exercises in history. We've got all of these vessels over there from the U.S. and allied nations attempting to defend commercial shipping. I wouldn't be surprised if we start seeing U.S. and allied naval vessels targeted themselves directly. It's just a powder keg here, folks. We're one step away from a major escalation. I mean, every day you read about this stuff, it seems like we're getting closer and closer to a broad regional war. And when that happens, you can expect the price of crude oil and commodities across the board to soar. Now, look, we'd probably all be better off if that doesn't happen. I hope it doesn't, but that doesn't mean that I'm going to ignore what I see occurring. And when that does happen, that very well could be the event that drives the price of gold past this critical level of resistance and sends it off to new all-time highs, probably somewhere around $3,000 to $3,500. If you examine the chart here, this cup and handle formation, you would expect when gold breaks out for it to go to somewhere around $3,100. The inflation-adjusted all-time high for gold is $3,300, I think, using the CPI. So probably actually somewhere significantly higher than that, since the CPI understates inflation. But that's what's going on. So do me a favor, smash the like button. Don't forget to share this with your friends, folks. What am I doing to get prepared? Well, I'm continuing to get into hard assets, continuing to accumulate positions in the miners as well as energy companies, because I think crude and gold are going to be going much higher. But hey, who knows? That's just my take on things. One thing you can guarantee is there's going to be a lot of volatility here, and at any time, just expect the unexpected. So thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.